Imagine missing like one single word on a piece of paper, and as a direct result, the government just padlocks the doors to your multi-million peso business.
It sounds like a gross exaggeration,
Yeah,
right?
it sounds totally fake.
But in Philippine tax law, it is actually a daily reality.
It really is. So welcome to a special CPA board exam review session of our deep dive here on ICPA Review Radio. If you are tuning in today, you are likely a very determined candidate staring down the barrel of the taxation subject.
Which is a beast.
Total beast. And today our mission is to conquer three highly specific, frequently tested sections of the tax code. We're talking sections 113, 114, and 115.
Right.
So that covers invoicing, filing returns, and the dreaded business suspension rules.
Yeah, and these sections are just absolutely critical because examiners, well, they know they're a total minefield for multiple choice questions.
Oh, for sure.
They blend these really unforgiving procedural rules with recent updates from RA 10963, right, the train law. So if you just rely on rote memorization without understanding the underlying mechanic.
Like the actual why behind it.
Exactly. Or if you gloss over the strict documentary requirements, these questions will just absolutely tank your overall score.
Yeah, you can't just guess on these. So think of the value-added tax system like a massive, incredibly exclusive nightclub. And the Bureau of Internal Revenue, the BIR, they're the strictest bouncer on earth.
Absolute strictest.
Right. To even get near the door, you need the perfect ID. In our case, that ID is the transaction document. So before we can even talk about calculating the tax itself, we have to look at how a sale is documented under Section 113.
Which starts with a massive trap.
Right. The trap that catches so many reviewees. The difference between an invoice and a receipt.
Yeah, because in everyday life, people just use those terms interchangeably,
Right. You buy a coffee, you get a piece of paper, you call it a receipt.
Exactly. But Section 113 draws a very hard statutory line. A VAT-registered person must issue a VAT invoice for every sale, barter, or exchange of goods or properties.
Goods or properties. Got it.
But conversely, they must issue a VAT official receipt for the lease of goods or properties and for every sale of services.
Okay, so goods get an invoice, services and leases get an official receipt. Let me guess. Examiners will set up this massive computation problem for a consulting firm.
A service business, yeah.
Right, a service business. And they'll casually mention that they issued a V8 invoice just to see if the candidate realizes the documentation is legally flawed.
Oh, they do it constantly. It's a classic trap. And the reason for this strict separation, well, it actually goes back to how the BIR historically tracked transactions.
Okay.
You see, goods involve physical inventory, right? You can count them. But services involve intangible performance.
Ah, so the audit trails are completely different.
Exactly. Completely different. You really have to train your brain as a candidate to instantly red flag any scenario where goods are paired with a receipt or services are paired with an invoice.
Okay, that's a great tip. So, assuming our bouncer accepts the type of ID, what actually has to be printed on it? I mean, the law requires the seller's taxpayer identification number, the TIN, and it mandates that the VIA amount must be shown as a separate item.
Right. It has to be clearly separated.
But things get really complicated when the transaction isn't your standard 12% taxable sale. So let's pause and define two terms that get thrown around like synonyms, but have vastly different mechanical effects on a business's tax liability.
Oh, you mean zero-rated versus VAT exempt?
Yes. Zero-rated versus VAT exempt.
Yeah, to understand the difference there, we really have to look at input VA. So output VAT is the 12% tax a seller collects from a customer, right?
Right, the money coming in.
Exactly. And input VAT is the 12% tax that the seller paid to their suppliers when they were buying materials.
Right.
So in a normal transaction, you collect the output VAT, you subtract the input VAT you already paid, and then you just remit the net difference to the government.
Okay, so if a transaction is VAT exempt, let's say, I'm selling raw agricultural food products, I don't charge my customer any output VAT or exempt.
No output VAT on exempt sales.
But the catch is, I also lose the right to claim any input VAT on the expenses I incurred to make that sale. I just have to absorb that tax as a regular cost of doing business.
Right, it just becomes part of your cost. But if a transaction is zero-rated, such as a direct export sale, you charge your foreign customer 0% output VAT.
Okay.
But you legally retain the right to claim all the input VAT you paid on your materials.
Oh, wow.
Yeah, you can apply it as a tax credit against other liabilities, or honestly even ask the government for a cash refund. So zero rated is really the ultimate VIP status in the VAT system.
Okay, I love that. Zero rated is the VIP pass, and exempt is like getting into the club for free, but you have to pay for your own drinks.
That is a perfect way to look at it.
So because the tax effects are so vastly different, Section 113 requires sellers to prominently stamp or print zero-rated sale or V8 exempt sale right on the document.
Yes.
And-
Prominently.
But what if they forget? Like, let's say I sell that raw agricultural product. It is legally exempt. But I just get lazy and issue a generic invoice without the V8 exempt stamp.
Well, then the documentation failure completely invalidates the privilege.
Wait, really?
Oh, yes. Section 113 is merciless here. If you fail to prominently display V8 exempt sale, the BIR will assess you for the 12% output, VAT, as if the transaction was fully taxable.
Ouch.
Yeah, you will pay that 12% directly out of your own pocket. So in a problem-solving question on the exam, if an exempt transaction lacks the proper stamp in the problem description, you must add it to the taxable base.
That is such a sneaky exam trick. Okay, I want to look at another scenario the outline calls the non-VAT imposter because, honestly, the penalties here seem almost unbelievable.
Oh, the triple whammy. Yeah.
Right. Let's say a small business with gross sales below the VAT threshold is subject to the 3% percentage tax instead of V8, but either by mistake or just outright fraud, they issue an invoice that has their TIN followed by the word V8.
They pretend to be a VAT taxpayer.
Exactly.
Yeah, the law just brings the hammer down on this. If a non-VAT person issues a VAT receipt, they are still liable for the percentage tax they originally owed.
Okay, that makes sense.
But in addition to that, they must also pay the 12% output VAT on that transaction, and they are strictly barred from claiming any input VAT to reduce it.
Wow.
And if that wasn't enough, finally they are hit with a 50% surcharge on the tax due.
Okay, let's run the math on that just to show how devastating it actually is for a business. Say I sell something for 100,000 pesos.
Okay.
I'm a non-VAT business, so normally I just owe 3,000 pesos for my percentage tax.
Right.
But because I use a VAT invoice, I now also owe 12,000 pesos for the V8, with absolutely zero deductions allowed. And then a 6,000 peso surcharge on top of the VAT. So that is a 21,000 peso penalty on a 100,000 peso sale just for using the wrong receipt booklet.
Just for the wrong paperwork. Yeah.
It's literally a triple whammy: percentage tax, gross output VAT, and a 50% surcharge.
The triple whammy is a really great way for you guys listening to memorize the issuer's penalty. But the law contains a really fascinating pivot regarding the purchaser in this specific scenario. Yeah, if the information on that erroneous receipt is otherwise complete, like it shows the TIN, it breaks down the tax, the VAT registered purchaser who received it can actually still recognize that VAT as a valid input tax credit.
Wait, I have to challenge the logic on that. Isn't that like rewarding the buyer for participating in a fraudulent transaction? The government is letting them claim a tax credit based on a fake VAT invoice?
It seems like that at first glance, yeah. But you have to look at the underlying mechanics of commerce. The law protects the innocent buyer who relies, in good faith, on a document that appears valid on its face. It places a completely unreasonable burden on a purchaser to secretly investigate the BIR registration status of every single supplier they buy a pencil from.
Oh, that makes sense. You can't audit everyone you do business with.
Exactly. And the government doesn't actually lose out because they are extracting that same VAT plus massive penalties from the fraudulent seller. So, going back to your analogy, the bouncer throws the imposter out of the club and confiscates their wallet, but lets the innocent guests stay at the party.
Let the innocent guests stay. I like that. It makes a lot of sense when you look at it from a macroeconomic perspective. You just don't want to paralyze business-to-business transactions.
Right.
And speaking of B2B transactions, we need to mention the 1,000 peso rule.
Ah, yes. So if a sale is made to a VAT registered person and the amount is 1,000 pesos or more, inclusive of VAT, the invoice or receipt cannot just be a generic cash register tape.
It needs more detail.
Way more. It must specifically state the purchaser's name, their business style, their address, and their TIN.
But why 1,000 pesos? I mean, it seems like kind of an arbitrary number.
Well, it is an administrative threshold. It's balancing audit needs with commercial reality. The BIR, they need a clear audit trail for significant transactions so they can cross-match the seller's output VAT with the buyer's input VAT.
Right.
But they don't want to halt commerce by demanding a full name and TIN every single time an office manager buys, like, a 50 peso pack of highlighters.
That would be a nightmare.
Total nightmare. So examiners will frequently use a transaction of exactly 1,000 pesos in a word problem.
Yeah.
They want to see if you know the requirement kicks in at 1,000, not just over 1,000.
At exactly 1,000. Got it. Okay, let's look at one final Section 113 trap before we move on. Mixed transactions.
Oh, these are tough.
Yeah. Picture this. You walk into a hardware store, you represent a VAT-registered construction company, and you buy standard taxable lumber, some VAT-exempt agricultural feed for landscaping, and some zero-rated export packaging materials.
Okay, all in one trip.
All in one trip, from one cashier. How does the seller document that without violating the rules?
Well, Section 113 actually gives the seller two options here. They can issue entirely separate invoices for the taxable, exempt, and zero-rated items.
Okay, separate paper for each.
Right. Or they can use one single invoice, provided it explicitly segregates the sales into those three categories and clearly shows the specific VAT computed only on the taxable portion.
Ah.
So if a seller hands you one piece of paper with a single grand total at the bottom for a mixed transaction, that documentation is totally invalid.
Invalid.
Okay.
Okay, so our bouncer has rigorously checked the ID. The invoices are segregated, the stamps are in place, the purchaser TINs are recorded, paperwork is flawless.
Beautiful.
But a perfect invoice doesn't automatically put money in the national treasury, right? The cash actually has to leave the business's bank account. Which brings us to Section 114, return and payment of value-added tax.
And this right here is where candidates using old review materials just get destroyed.
Yes. Let's talk about the train law update.
Yeah, because historically, VAT-registered persons face this grueling schedule of monthly VAT declarations. And then that was followed by a quarterly return. But RA 10963, the train law, fundamentally altered this timeline.
Right, so beginning January 1st, 2023, the monthly payment requirement was entirely abolished. The filing and payment of VAT are now strictly done within 25 days following the close of each taxable quarter.
Exactly.
So if my quarter ends on March 31st, I have until April 25th to file and pay. Why did the legislature make that specific shift, though?
Ultimately, it is about administrative efficiency and the ease of doing business. Preparing a VA return, it requires reconciling subsidiary sales and purchase journals and encoding these massive summary lists of transactions.
It's a ton of work.
A ton. So moving to a quarterly system just drastically reduces the administrative burden on both the taxpayer and the BIR.
But it also forces a business to be highly disciplined with their cash flow, right? I mean, you are holding on to 3 months' worth of government money at that point.
Yeah, that's the danger.
If a business uses that collected VAT to pay for their own operating expenses, they're going to face a massive cash shortfall on day 25.
Exactly. And examiners will test this new rule by giving you a scenario set in the current year, and one of the multiple choice distractors will inevitably be an old monthly filing deadline, like, 20th of the following month.
Oh, they love doing that.
You must ignore it. Stick to the 25 days following the close of the quarter. And if a business completely cancels its registration, the clock starts immediately. They must file and pay within exactly 25 days from the date of cancellation.
Good. Write that down if you're listening. Now, let's talk about when the government is your customer.
Government withholding.
Yeah. Say I sell 1 million pesos worth of office supplies to a government-owned or controlled corporation, a GOCC. The bouncer steps in again, but this time he's taking a cut at the door, right?
Basically, yeah.
The government withholds 5% VAT before they even pay you. But the text we're reviewing highlights a major shift that happened in 2021 regarding this withholding.
Yes, and this is a highly testable computational area. Prior to 2021, the government withholding was a final tax. Today, it is a creditable tax.
Okay, let me try to break down the mechanics of that shift for everyone.
Go for it.
Under the old final tax system, if the government withheld that 5%, that transaction was essentially quarantined. The 5% covered your VAT obligation for that specific government sale entirely.
Right.
You didn't mix it with your private sector sales, and you couldn't claim any excess input VAT related to it. It was just a closed loop.
That is a perfectly accurate description of the old rule. But under the current creditable system, it is just an advance payment.
Oh, okay.
So at the end of the quarter, you throw all your sales, both government and private, into one big calculation. You compute your total output VAT on everything. You subtract your total input VAT on all your purchases.
Right.
That gives you your net VAT payable. Then, as the very last step, you take that 5% the government already withheld and apply it as a direct deduction against what you owe.
Ah, so it's a true tax credit. So if a computational question on the exam asks for the final VAT payable, and a candidate treats that government sale as a final tax, like excluding it from the main computation, their final number will be completely wrong.
100% wrong, yes.
Are there any exceptions to this government withholding rule that we need to know?
Just two main exceptions to keep in mind for the board. If the payment is for the lease of property to a non-resident owner, the withholding rate is actually 12% at the time of payment.
Okay, 12% for non-resident lease.
And if the purchases arise from projects funded by Official Development Assistance, or ODA, they are entirely exempt from this withholding tax system. The government just pays in full.
Got it. Okay, so we know how to check the ID, and we know exactly when and how to pay the cover charge. But what happens to the taxpayer who decides, you know what, the rules don't apply to me?
The ones who think they can cheat the system.
Exactly. They don't segregate their invoices. They skip the 25-day deadline. They deliberately hide their sales. The bouncer doesn't just kick them out, right? The bouncer padlocks the entire building.
This brings us to Section 115, which grants the Commissioner of Internal Revenue the really formidable power to suspend business operations and temporarily close the establishment.
Oh, plan candido.
Right, Oplan Candido. And the closure is for a minimum duration of 5 days, and it is only lifted upon full compliance.
I mean, a minimum of 5 days of zero revenue can completely bankrupt a small business.
Oh, absolutely. It's meant to hurt.
So to help you guys remember the specific grounds for closure, use the mnemonic 30FFF.
Right.
The 30 stands for a 30% or more understatement of correct taxable sales or receipts.
Okay.
And then the 3 Fs, failure to issue receipts or invoices, failure to file a VAT return, and a failure to register.
And of those 4 grounds, I want to emphasize the 30% understatement rule is by far the most heavily tested on the CPA exam.
But why 30% though? Like if an audit reveals I deliberately hid 20% of my sales, I'm still committing tax evasion. Why does the BIR wait until a 30% threshold to use Section 115?
It really comes down to materiality and administrative due process.
Okay.
You know, accounting is complex. A 10% or 50% discrepancy, well, it might just be a timing difference or a misunderstood exemption or just a simple clerical error.
Our humans make mistakes.
Exactly. And the BIR can assess regular penalties for those errors through standard audit procedures. But a 30% gap.
That's huge.
Right. That strongly indicates systemic, deliberate suppression of sales. It crosses the line from a simple audit adjustment to a severe violation that justifies immediate operational suspension.
So the 30% is really a legislative bright line. Let's look at an exam trap based on this. Let's say a problem states an audit reveals a VAT-registered taxpayer understated their taxable sales by 28% for the quarter.
Okay, 28%.
Can the BIR immediately suspend their operations under Section 115?
No, they cannot.
Wait, really? Not even at 28%?
Nope. The commissioner cannot use the immediate suspension power for 28% understatement. Tax law requires strict statutory construction. The threshold is 30% or more. And the examiner will specifically put 25% or 28% in the problem to test your nerve. They want to know, do you know the precise rule, or are you just guessing based on what feels like a really large number?
Right, because 28% feels like tax evasion.
It does. But close enough does not count in taxation.
A bright line is a bright line. I love that.
Yeah.
And the other 3 grounds, failure to issue receipts, failure to file the return, failure to register those, are binary, right? You either did it or you didn't.
Exactly.
If you miss that 25-day deadline following the close of the quarter, you are automatically vulnerable to suspension.
And the synergy between these sections is really what makes them so testable. A failure in the invoicing of Section 113 or the filing of Section 114 directly triggers the devastating penalties of Section 115. They're all connected.
That's a great point. Okay, this brings us to our exam day checklist. We are going to distill this deep dive down to 4 rapid-fire points you need on your mental flashcards before you walk into that testing center.
Let's do it.
Number 1, documentation parity. Goods equal a V8 invoice. Services and lease of properties equal a VA official receipt. Mix them up, and the document is invalid.
Number 2, the triple whammy. Remember, if a non-V8 person issues a V8 receipt, they pay their percentage tax, they pay the gross output V8 with no input credit, and they pay a 50% surcharge.
Brutal.
But remember, the innocent VAT-registered buyer who receives a complete document can still claim the input tax credit.
Yes, protect the innocent buyer. Number 3, the train law timeline. Monthly V8 payments are a thing of the past. Filing and payment are strictly done within 25 days following the close of each taxable quarter.
And number 4, the 30% bright line. To trigger business suspension under Section 115 for the understatement of sales, the understatement must be 30% or more. 29% will not trigger immediate closure.
To everyone listening out there, mastering these mechanics, like really understanding why zero-rated differs from exempt or why creditable taxes change a computation, exactly what separates a struggling candidate from a fully licensed Philippine CPA.
Absolutely.
You are putting in the hard work, and it will pay off when you see these scenarios on exam day. You've got this.
And as you continue your practice drills today, I want to leave you with a final thought to ponder. We discussed how the shift from a final to a creditable 5% government withholding tax fundamentally changes a tax computation.
Right.
But I want you to consider how it changes a company's internal accounting. If that cash withheld by the government is no longer a final settlement but merely an advance credit, how does that dictate the specific journal entries a bookkeeper must make in the subsidiary sales journal required back in Section 113?
Oh, that's interesting.
Yeah, moving from recognizing a final tax expense to setting up a credible withholding tax asset changes the entire face of the balance sheet.
Connecting the tax code mechanics directly to the financial reporting ledgers. That is the exact level of critical thinking the board exam demands. Keep pushing, keep reviewing, and we will catch you on the next deep dive.